China. China? China, China, China. I have to have my China. China, China, because China.
A look at our Forexfundys calendar shows 8 major currencies. But George, where's the yuan? If you have a video on China, shouldn't it be on the chart?
Shut up, bitch!
Yes, technically you're right. The Chinese yuan does exist, but it's not a freely traded currency like the major currencies that we look at, the euro, the US dollar, the Great Britain pound, the Aussie, the Canadian dollar, etc. The yuan is managed by the People's Bank of China.
China. China?
And they keep that on a tight leash. Still, ignoring China and Forex is like ignoring the sun because you're wearing sunglasses. It still affects everything. Now, China matters because it's the manufacturing shark of the global ocean. You've probably watched Shark Week and you've seen those little fish on the sharks. In this video, we're going to refer to them as AUD and NZD. They feed off of the shark's movements. When China's economy grows, it buys more raw materials from Australia and dairy from New Zealand. And when it slows, demand for those exports drops. And then you see a dive in those currencies. And this is why traders watch Chinese data even though they're not directly trading the yuan. You're going to get a little throwback into Module 1, as the key data that we watch are the following. GDP. When China's GDP rises, it signals global demand and industrial activity are healthy. That's where you see a rally in AUD and NZD because it means that the shark is eating. PMIs. It measures factory and service activity. When Chinese PMIs slump, it means that factories are producing less. Fewer exports and imports. Weaker demand in Australian iron ore or New Zealand dairy. Trade balance. This tells us how much China is importing or exporting. A big surplus means that factories are pumping. You know, pump it up. You got to pump it up. But a drop means that global demand is cooling. AUD especially reacts for this because it's tied to China's export engine. Retail sales. This tracks consumer spending. If domestic demand grows, it cushions any export slowdown. So strong retail sales numbers are bullish sentiment. Industrial production. This is a pretty big one. This measures how much China's factories are actually producing. Think of it as factory output in real time. When they're higher, that means more raw materials are needed, and that's good for the Australian dollar. Housing data. This can be stuff like new home sales, construction, new starts. China's property sector is massive. It's around 1/4 of its GDP. When housing struggles, the demand for copper and steel collapse. And that's why bad housing data is bad for the Australian dollar and global market sentiment. PPI. Rising PPI indicates cost push inflation globally, whereas falling PPI indicates deflationary signals, which can drag commodity currencies like the ones that we talked about lower. And lastly, policy announcements. Whenever China sees rate cuts, eases lending, or launches stimulus, AUD NZD usually pump it up because it means that China started hitting the gas again. And usually China causes a global chain reaction. When China slows, commodity demand drops. You see the export in these countries falling, their currencies weaken, and risk-off spreads throughout the markets. Flip the scenario. When China stimulates, these commodities rally, the currencies strengthen, and a risk-on mood returns. And here I'm going to show some examples on how tariff talks can actually affect these currencies as well. When doing analysis, you can see here that we're comparing all these currencies, the euro, the pound, the kiwi, the Australian dollar against the US dollar. Typically when comparing against the US dollar, most of these currencies will move on the same direction around the same time. However, when tariffs on China were announced, not only could that cause a sell-off for the US dollar because investors are shaking in confidence, but because of the involvement with China for AUD and NZD, you'll see that they dropped even further. So while GBP USD flew, the Euro USD flew because people were getting out of the US dollar, people are also getting out of China domiciled currencies. So to wrap it up, even if the yuan isn't on your screen, China moves your charts. Its growth fuels commodities, trade, and global risk sentiment. So make sure you watch the shark because the little fish will follow.
China. China?